Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And good day, Rick Durkee here with you on Navigating Retirement. Thanks for joining us again for another podcast edition of our show. Today, what we're going to talk about is understanding your investment options. On this program, we're going to discuss a few of these different types of financial products you can use, maybe a different method or two that you can seek financial advice for counsel. And so let's get started right away. First of all, you got banks. Now, most of us know that banks offer FDIC insurance. They're a safe place to put our money. Checking accounts can manage your daily cash flow or weekly cash flow, however you do your cash flow planning, your expenses versus revenues, and pay your bills. Let's remind ourselves here that, last year banks charged over $6.4 billion on ATM fees and overdraft fees. So let's make sure that we're not paying the banks what they don't need to get paid if we pay attention to our balances and manage our money properly. Savings accounts, another bank product, slightly higher interest, but minuscule when we're talking about what we could get in the market with investment returns. But here, this is the deal with bank products. They're safe. They have the FDIC insurance. Still, they have low interest. And if you're not properly bucketing your money for retirement, you could be running into a situation where you're maybe earmarking money for money used now. And if you use the money now, it does need to be in a safe account like a bank product. But if you're using it later, you might be calling that bank money lazy money because it could be working a little bit harder for you if you had a longer time horizon to use it. CDs, another opportunity. CDs, they used to stand for certificates of deposits. Today, they stand for certificates of depreciation because you're losing money to inflation. And they do give you a promised set rate of return that you can bank on. But let's just put it clearly, you're not going to become rich with CDs, but they're good for short-term investments. Money markets, safe, similar to savings accounts, also have maybe a little bit higher account minimums to give you a little bit more interest. So what's the next alternative to safe money products in the banks? Well, you've got bonds. Now, bonds in general have some risk to them. You can look at some bonds that have credit or default rate risks. Those would be some of your high yield corporate bonds, things like that. You also have interest rate risk in bonds. If you're holding a bond for long maturity, you're definitely going to run into some issues when we're in a low interest rate environment. Interest rates start going up because we know that there's an inverse relationship between the income on those bonds and actually the interest rate that you're getting paid. Interest rates go up, bond values go down. So we could run into that kind of risk. We have duration risk, call risk, and then bond rating risk. I mentioned high yield corporate bonds before. Those were renamed after a little bit of a meltdown in junk bonds, they were called, and then they became high yield corporate bonds. But they're lower ratings of those companies, so you can expect that you'll get higher yields, but you might have a little bit more risk that the company offering those bonds or the municipality or whatever may run into some issues. Bonds versus bond funds, simply stated, you have an investment manager that works for an investment company that puts together a portfolio of bonds, and that's a bond fund. It's just like a mutual fund. Types of bonds, we touched on a few: U.S. Treasuries, corporate bonds, high yield corporate bonds. The Treasuries run on a short term, intermediate term, or a 5-year, 10-year Treasury. They are backed by the full faith of the U.S. government, the full faith and credit paying ability. I don't know. If you're like me, I'm a little bit worried about what we got going on right now with all this debt that our country has. So but I think we're still good. U.S. savings bonds, another option, mortgage-backed security bonds, TIPS, municipal bonds, corporate bonds I talked about before, many different bonds. Certainly you want to look at these products, evaluate them. They were known as safe products, our bank products and our bonds, but we do know that there are some risks with them. We look at 2008. If you were in a 2010 target date fund at that time, stocks and bonds in 2008 lost value. We saw value drops in those type of target date funds in 2008 at about 37%, and that included stocks and bonds. So you always have to evaluate the risk in any investment. Stocks. Let's go on to stocks. A lot of people think a lot about stocks today because the market's going up. Sometimes we think maybe it's a herd mentality. Jump on the bandwagon here and get some of those great returns. Buy some GameStop, right? Right at the right time. But stocks actually do have these risks. Stocks don't have any guarantees. Stocks go up and stocks go down. I always like to say that. That's the one guarantee about the stock market. It will always go up and down. We just don't know when, okay? Share prices can go up and down in stocks. That can affect our value. You have value stocks, you have growth stocks, different options that you can buy on stocks, many different ways that you can work in the stock market to try and get gains. You can get dividends. You can get dividends as income, or you can reinvest those dividends and grow your funds. You can put IRA dollars into the stock market. You can get stock market indexes. You can go to a company like Vanguard. They have all kinds of indexes. Those are non-managed groups of assets that mimic or use a benchmark index, such as the S&P 500, the Russell 2000, Dow. The Dow is an index. You can buy funds that mimic those indexes, and those are lower cost because there's no management involved with them. You have options now with mutual funds that you can use that some mutual funds are going to have the opportunity to have that investment manager. Hopefully he has some tenure. You can go on Yahoo Finance and look up mutual funds. You can find out information about each fund, the tenure of the manager that's been working that particular fund, how long he's been there, she's been there. You can also find different opportunities to look at the expense ratios in your mutual funds. Sometimes those details that are a little bit left lost, but they're found in that big, thick book you call a prospectus. Now, new version of mutual fund that's called an exchange traded fund. Now, the biggest difference between mutual funds and exchange traded funds is the fact that exchange traded funds are traded intraday versus your mutual funds that are only traded and their NAV or net asset value is calculated at the end of the day. Hey, a couple of minutes here now on a few other financial products. Let's talk a little bit about some insurance products. Annuities. Annuities, often misunderstood. Many different variations of these products. Here's my Annuity 101 class for you today. When you look at annuities, you should be thinking about, do I want an immediate income annuity, or do I want a deferred annuity, which I may never take income out of? I may just be using the annuity product for its different benefits. So the immediate annuity is similar to your Social Security. You give the insurance company a lump sum of money, and then they give you a promise or a guarantee to pay out that money, guaranteed over a period of time. It could be your lifetime. It could be for your lifetime, and if you die first, your wife could continue that annuity payment for a percentage maybe. This is similar to a pension, the old pension plans that have gone by the wayside, where you have a wife inherits that pension at the husband's death, and she might get 50% of that pension, for example. So those are examples of immediate annuities. Fixed annuities, the next type of annuity, it's a deferred annuity. It's like a CD at the bank, but no FDIC insurance. And that fixed annuity is just going to give you a stated rate of return for a period of time. Now, I'd like to make one point about annuities here. If you put after-tax dollars into an annuity, you get tax-deferred growth. Okay, say that one more time. Tax-deferred growth inside of an annuity. But when you take that tax-deferred growth out, it's based on accounting principles of last in, first out. So you're going to see that taxation on the gain in the annuity, and it's not at capital gains rates, folks. It's at ordinary income tax rates. So keep that in mind when you're doing some planning with after-tax dollars inside of annuities. IRAs work very well in annuities. That might go contrary to what a lot of people think, that an IRA might not work well in an annuity, but they can, because you can transfer the annuity into another financial product at a future point in time and still not pay taxes on it, because you just re-register it with another custodian as a IRA. Here's another type of an annuity, a variable annuity, another type of deferred annuity. All of these annuities could have some form of income guarantees on them or lifetime income benefit riders, but the variable annuity is subject to market risk. Its accumulation value can go up and down. If you want to take that risk off the table of market value risk adjustments, you can definitely put riders on the contract to provide you some guarantees of income. But be careful. When you look at an annuity, you should also understand all of the benefits and features and understand what you're paying in fees for those type of products. Fixed index annuity, it's a hybrid product. It is a product that includes the opportunity for growth in market type indexes. You're not in the indexes itself. You're not going to get any dividends, but you can have protection against downside risk in the market. Fixed index annuities are great retirement income planning tools. So make sure you look into that type of an annuity for your income planning if you're at or nearing retirement, whereas the variable annuity might be more set up for a younger person. All right. Couple other things here: real estate opportunities, real estate investment trusts, investment property, 1031 exchanges, all a bunch of different ways that you can do some planning with real estate products in your portfolio. Always diversify, have a little bit of this, a little bit of that. I didn't talk about commodities, gold, silver, things like that. It's good to have a good overall mix of all these things. And don't forget one other insurance tool, folks: life insurance. People think that life insurance isn't a useful tool as we get older because we don't have to protect our income anymore when we retire, right? Well, wrong. We may use life insurance to pass on tax-free, income tax-free dollars in our estate plan, or we may withdraw out of those cash values in permanent life insurance some cash value through withdrawals and loan provisions inside those contracts and do it income tax-free. Listen, in general, a lot of products on the insurance side, a lot of types of life insurance. Let's just say this: all of these products that we talked about today should be thought about as opportunities, but have the plan first. Know what you want and need to do with your money first, and then develop a retirement income plan and sit down with us at the Coastal Financial Planning Group. Know what your tax status is going to be and how you're going to take assets from different categories in your income plan to save taxes in retirement. Go through that income planning process with us here at the Coastal Financial Planning Group. Hey, we help a lot of savers and investors to determine their outcome and their goals by going through that planning process. We've always called it the 3-step review process. And then you sit down, we go through this process, and you learn what's in your best interest so that you can make sound financial decisions for yourself. Hey, thank you for your time today. A lot of good information. Follow up. Take action today. Give us a call, 843-735-5065. We're always available. Hey, text us. You can text us at that number. If it's after hours and you're watching this show, remember, we're on demand, navigating retirement. Watch us 24/7 anytime in the comfort of your own home. And remember too, it's easy to pass on these episodes of Navigating Retirement to other people that you might know that might benefit from them. That's all we have for time today. We'll look forward to seeing you on the next episode of Navigating Retirement.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.